Welcome to Applied Financial Accounting course. Reference to this video is 038. As I mentioned previously, we will be discussing exactly the accounting cycle, in particular accounting equation in the previous videos. So to go there, I would like to reiterate as a review of what we did in the first video and the second video. Those who are beginners, I strongly recommend to look at video 1 and video 2 before looking at this video. And here, what we're going to talk is a review of what assets are, liabilities, and owner's equity. And we will have a case study for a company called AAA. Before you move forward, you may pause here and read this. Assets. Assets are resources owned by the business. And in fact, the businesses use the assets in carrying out their business operations. So assuming that the company is a merchandise company, let's give an example of a grocery store. I'm sure everybody goes to grocery store at least a couple of times in a month to do shopping, and then their operation, without going into details, is making sure the shelves are full, making sure that they get their products from their suppliers, and then making sure that they are available for customers. And then same for manufacturing. For example, a company manufactures certain products, so they also use these assets to manufacture their products. And then services, let's say certain companies provides services. They are not manufacturing, they are not selling any tangible assets, but they are providing some services, so they also need these assets to carry out their operations. So what are those assets? Cash, machinery, equipment, land, buildings, investments, and accounts receivable. And accounts receivable is sometimes referred to, we make a sale or we provide services to our clients, but we don't get it in cash. So instead, it's on credit. The service, we provide the services, but we get paid later, and that's called accounts receivable. Liabilities. So liabilities are the credit claimed against total assets. For example, we buy something from our suppliers, but we don't pay them in cash. We pay them later, and that's the accounts payable. Or the borrowings. For example, we need money to borrow from individuals or from banks, referred to debts and loans. Owner's equity. Owner's equity is claim against total assets. If you can give an example, the example is retained earnings. I know there is also common stock, but I'm not going to touch it. It's more than basics. So we will, when we get there, we will also be touching that. So I also just saw repetitive of cumulative earnings and earnings. So what is retained earnings? So retained earnings is that all the cumulative earnings that are not distributed to shareholders, and they stay with the company. For example, in January, the company has a retained earnings of $5. In February, what happens is that we have the $5 from January, and then in February we make $7 as a retained earnings. So then $5 plus $7, we have $12. And in March, we have the cumulative earnings from January and February, which is $12 here, and then we make retained earnings of $15. So both of them, adding them both, makes $27. So here we will be covering accounting cycle, basically focusing on accounting equation, identifying transactions, analyzing, and recording transactions. So in the next video, we will be going through the specific case study, which is referred to video 3B. Thank you, and See you in the next video.